Hi, I'm MaryAnn and I'm here today with James Upton, who is Chief Strategic Officer of Emerging Markets at Morgan Stanley Investment Management. Good to have you, James.
Thank you for having me.
We're talking about, of course, emerging markets. What else are we going to talk about today? It's been down about 11% over the past 12 months. You know, is there any opportunity, or is this just a pullback?
Sure. There's always opportunity in emerging markets, particularly equities, which is what we invest in. But there have been challenges the last few years, and part of that is because investors are sort of adjusting their expectations to what they should get for return in emerging markets. Remember, it wasn't that long ago when you were making 40% a year.
Quite a good run for a while.
For a while, about 2003 to 2007 on average. That's about what you made in emerging markets. And I think a lot of people became very comfortable with those double-digit returns and thought, well, emerging markets are always supposed to give you that kind of return. One of the reasons people invested in emerging markets in the first place, going back many years, is because they grow economically more than Canada and the US. That's the whole reason for being there, or that's been the simple metric for being there. The differential between emerging market economic growth and developed economic growth used to be about 3 to 1. That's moved down the last few years to about 2 to 1. So since the global financial crisis, since commodities hit their peak about 4 years ago, since China has begun to slow down a little bit, all the major emerging market countries, particularly those that were exporting commodities like Brazil and Russia, have slowed down.
So what are you seeing right now then?
Oh, there are lots of opportunities. I do have to point out that still lingering over emerging markets this year, and so therefore what might be a source of negative sentiment, is the fact that China has delivered economic growth in the last 4 years by issuing a lot of debt. I'm sure people have read about shadow banking in China. This is sort of lending that isn't terribly clear how it occurs. There's been lending on the part of the central government to various regions. And there's, as we know, in our countries, whenever there's a lot of lending, there's bad lending that occurs. And what's unhealthy, in our opinion, is that the rate of credit growth in China has exceeded the amount of GDP growth by quite a wide margin these last few years. All the work we do internally shows us that China actually will likely slow down economically more than most people expect. Now that's going to have consequences that may linger over the markets this year, because there are still high expectations for some commodities prices, and some people still look to China as sort of the benchmark country. But what's important is that there are other countries where a lot of good things are happening, and this includes places like Mexico, the Philippines, Poland, countries that aren't as big in the index, so they don't get as much attention, but in fact reforms taking place. Mexico has just passed back in December the energy reform, which is historical.
So what you say then, China doesn't necessarily, I guess, stand out in the emerging markets?
It does still stand out because
it's still the biggest
big.
player.
It's big, and it's a big country with a big weight in the index that does still drive a lot of prices of things in the world. But it's not the only emerging market. I think as we start to see some political changes occur this year, those might prove to be the positive catalysts that encourage some investors and take a little of this focus off the problems in China. India is holding elections in May. India, as everybody knows, a huge country, but it's had major macro and political problems over the years. Anyone who's been to India knows they don't spend sufficiently on infrastructure. It's very difficult to get around. Everything's insufficient, from airports to roads to everything else. And these are things they need to address. They need to deal with inflation. There are a lot of things that need to get fixed in India. But aside from all those problems in India, there have been great companies to invest in. So it might be, you might go down a muddy road to go into a tech office in India, but once you get inside, it's like anything you'd see in Palo Alto, California.
So it's just so much extreme almost.
Well, that and the fact that there are good quality, well-managed companies that are privately run. Whether it's a tech company or a bank or a healthcare company, there's lots of opportunities in a country like India. I think what the market needs is some catalyst to feel a little bit comfortable that there's reason to be encouraged again.
So where are you finding these growth opportunities right now?
Mexico is certainly one of them. I began to mention that energy sector reform was historic in December. Basically, what it means is that foreign oil companies are going to be able to help in the exploration and production of oil and shale gas in Mexico, which have been very inefficiently run because it's a state-run company. So this is something that is likely going to contribute to higher economic growth in Mexico. Mexico's always needed that. Things are looking encouraging in Eastern Europe, so Poland and Czech Republic and Romania. They're part of the European Union, but they're not part of the Eurozone, so they have competitive currencies, but they have really smart people that are able to manufacture goods in a very efficient way, so they benefit from the economic recovery we're beginning to see in the European Union, particularly places like Germany. And countries like Poland benefit from that. So you can invest in a bank or a biscuit maker or anything like that if you know management and pay attention to how they're growing earnings. There are lots of good opportunities.
So where do you find stocks then? You must go around and actually dig through the numbers?
We do. Our team travels a great deal. That's an important part of how we invest. We think it's important to be on the ground, to look at what's going on and to understand how management's running the company. And then it's important to go see local economists. It's important to talk to someone at the finance ministry. You need to understand how a country is managing its macroeconomic policy, and you need to see what's happening on the ground, and you need to meet management across the table over many periods of, over a great deal of time, over years, to really get a sense you can trust them, that they give you guidance that will end up in earnings results that you can trust, and that takes time and that takes work. But those opportunities are out there. If you look carefully and if you make some very rigorous country allocation decisions.
So it sounds like within the emerging markets there's a lot of different cycles depending on the country and the economy.
Yes.
And it's just a matter of definitely going through and weeding all those out, which is very hard to do for an individual investor.
It's hard to do for an individual, which is why some of us make a living doing it and have a very good time doing it, because it's a great deal of it's obviously very interesting to go to places like Philippines and Mexico and Brazil. And I think that one of the things that just helps people, put it in perspective is here in Canada and in the United States, everybody has a bank account, everybody has a mortgage, or most people do. These are things that are commonplace. There are countries like Indonesia and Philippines where people don't even have a bank account, let alone a credit card, let alone a mortgage. So often in emerging markets investing, it's just identifying which countries where credit penetration is very low, but likely to rise. And this provides opportunities. You can invest in a well-managed bank in an individual country.
Sounds very interesting.
It is good fun.
Thank you very much, James.
Thank you.
I've been joined by James Upton, who is Chief Strategic Officer, Morgan Stanley Investment Management. Thanks for watching. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.